The opinions expressed on this program are those of the program hosts and guests and not necessarily those of this station, management, staff, or sponsors. WPSL does not endorse products that may be mentioned. Any reproduction or retransmission of this broadcast is strictly prohibited without written consent of WPSL.
Welcome to the Sun Palm Financial Broadcast, and today your host, Dave Thomas.
Hey everybody, welcome to the Sun Palm Financial Broadcast, where we talk all things money. I'm your host, D.Thomas Cummings, and my friends and clients call me Dave, and my co-host is Sandra Liliana. Today she's out on appointments most of the morning and afternoon. So I'm going to be running this one for you today. Today we have a lot of great information, but I just want to let you know, as you're tuning in, we are broadcasting live from the Treasure Coast, Florida, and we're heard worldwide on Alexa, Google Home, and the TuneIn app. So if you're looking for us, that's one way to find us. Now, as we're getting started, I want to advise that sometimes we often will make some recommendations or some financial suggestions in the broadcast. So we do a quick disclaimer. So the information, opinions contained in the broadcast have been obtained from sources believed to be reliable, and they are given for informational purposes only. The information is not intended to be used as the sole basis for financial decisions or solicitation to sell. Now, today's topic is going to be basic investment vehicles. And we're not talking about cars. We're talking about getting your money to move in the right direction. So we're going to be looking at a couple of different ones. So we'll be talking about the most common types, such as your company-sponsored retirement plans, also pension plans, 401ks, government-sponsored plans, individual retirement accounts, also referred to as IRAs, and then a kind of a lack of better terms, a secret one that a lot of the high net worth folks use, and we do quite a few of because they're so great. So if you could stick around towards the end of the show, we're going to save the secret for last. So what I'd like to do first is ask the question, what are you doing to prepare for your retirement? All right, so we want to hear from you. Give us a call at 772-340-1590. That's 772-340-1590. Give us a call, let us know. So, all right, last week we had talked about life insurance. We put a big emphasis on this life insurance stuff in March typically, and the goal, of course, is to remind people, protect your loved ones, protect your future. Sadly, every year I reach out to all my friends. I do the same thing. I say, hey, get your life insurance, make sure you're covered. Half of them blow me off, and we lost 2 friends this year. And like I told another friend of mine, I said, I get tired of putting together or sharing GoFundMe accounts, because not only are folks not protecting their family, their children, their wife when they pass away, many don't even have final expense insurance, which is to cover the cost of a funeral. This is terrible. So that's the first and most important thing you should do as an investment for your future, because really, like I said in the last show, we all have a date with death. We don't know when it's going to be, and that's a horrible way to look at it, but it's a date that we will definitely keep. But we need to make sure we're prepared for that moment. The second part of every investment person should be to go ahead and prepare for your retirement. Now, we talked a few shows back about Social Security, and the concern there was we looked at the numbers from Social Security trust administrators, and we discovered something quite alarming, which was that in 2034, they're saying that it would be insolvent. They would only be able to pay out about 80% of their claims. And therefore, that's just one last part of the component before it goes bankrupt. And then the next generation wouldn't really be able to have anything. So there are some changes in Washington that we mentioned up there for that. So my point was in that show, and you can check it out on PSL TV on YouTube. Point about that show was don't expect the government to take care of you when you get old. And also, it's really not going to be a whole lot of money. So some things to think about there. All right. So as we're getting into the next part of this, we're going to be highlighting some of the things that you can do as an employee, as a small business owner, as the average Joe, where you can invest for your future and be ready for retirement. So we're going to talk about a couple of different investment vehicles. But before I do, there's something I like to always highlight, because if we don't take an assessment of where we were, then we don't have a good understanding of where we are, and we certainly won't have a good understanding of where we're going to be in the future. So if you recall, back maybe, I don't know, 20 years ago, almost every employer, almost all of the big ones, had a pension plan. So how did that work? Well, it worked like this. If I worked for your company for 20 years, 25 years, 30 years, whatever the requirement was, you thanked me for my loyalty, my service, and my dedication by offering a pension, right? And now some of the pensions would pay you 50% of what your income was when you retired from the company. Some would pay you up to 80% and these kinds of things. Those, my friends, are gone. There's only a few places left that give you a pension. Typically, those are going to be in government type of jobs, maybe your teachers, maybe your firemen, law enforcement, military. But in the private sector, they've all but vanished. There's a few companies that still offer them, but not many.
So, plus, for a pension, you pretty much had to work for the same company for a long time.
Exactly.
If you change jobs,
that's right.
That complicated everything.
That's right. So great point here. If we're talking about even collecting a pension, first of all, you'd have to be vested, which would be a certain amount of years. And then after that, your pension depended on how many years you completed or finished out and so on. And so, yeah, you're pretty much your whole life for a company. So most people would say, I'll jump on that these days, because it's almost as if employees have become expendable. So 1 minute you're hired and you can be terminated at any moment without much thought or care. And in fact, the numbers are showing, as we've been looking at this lately, that a lot of the layoffs happen right in December. Right before Christmas, they cut you. And this is a terrible thing. And we're seeing this. You used to get a Christmas bonus. Now you get your walking papers. And the reason why they're doing this, of course, is the last quarter of the year, they want to report higher earnings. That's their last chance to get the numbers back up there for stockholders and stakeholders and whatnot. And so they'll cut you in December so that month they don't have to pay a bunch of employees. And then we've actually seen people then go out right after that and rehire everybody, or not everybody, but several people in January. Hey, that's why you see your job disappear and then you see it reposted and at the end of the, anyway. What is the moral of this story? Only you can protect your financial future. You must invest in it. So there's a couple of different vehicles that they have out there to get your money moving. So let's first talk about 403B. So this is typically going to be a retirement savings plan that serves employees in the public sector. So we're even seeing, by the way, some municipalities get rid of pensions and just shift over to the 403B and thrift savings plans. But I digress on that one. So here we have the 401(b), and I have some recent stats for 2024. So I'm going to be looking down a little bit here for those of you who are watching to make sure I give you the correct numbers, because these things can change from year to year and whatnot. So we're talking about contribution plans for public people. And so the contributions 403B plans are made through payroll deductions. The IRS limits the amount that employees can contribute to their 401(b). So there's limits to how much you can put in. The advantage of it includes a faster vesting of funds and the ability to make additional catch-up contributions. Investment choices may also may be more limited than some of the other accounts and offer less protection from creditors. That's something that's pretty important for people to know. Typically, your investment for your retirement is protected from creditors. So if you happen to go have a difficult year, and some people have had charge-offs, bankruptcies, these kinds of things, most of these investment vehicles are protected, but not all. It's important to reach out to your HR person, wherever you are, and kind of discuss that, especially in these tough times. Now, the 2024 401(b) contribution limit is $23,000 for pre-tax and Roth employee contributions, and $69,000 for employer and employee contributions. Now, employees who are 50 or older can save an extra $7,500 a year and catch-up contributions. This brings their employee contribution limit to $30,500, as in 2023. Your total contributions can't surpass your yearly earnings at the employer that offers you the plan. So essentially, as we're looking at the contributions here, you can only make so much into it. Once you hit 50, you can throw an additional amount towards it, and then it's capped at that point, right? So for instance, combined employee and employer contributions there are limited to the lesser of $66,000 in 2023 and now $69,000 in 2024, or 100% of the employee's most recent salaries. And participants must reach the age of 59 and a half before withdrawing funds, or they get slapped with an early withdrawal penalty. So really what we're talking about here is, yes, you can make your contributions and you have limits to them. And once you hit that limit, you really can't make any more contributions. Now, I don't know many people these days right now who have so much money laying around that they can just, keep putting money. But it's important to know that, because there are some folks who, let's just say right now, you are a couple and your children have gotten to the age where they're now off to school. You don't have to see them every day or care for them every day. And maybe the young lady has gone out to the workforce again. And so, but up to that point, maybe her husband's income was sufficient. And so what she can do is essentially put as much as she can into the 401k. And that way there's a larger retirement set aside. But keep in mind, it's in her name only. So maybe it would be smarter to kind of distribute out those contributions with what they can afford. And then that way he puts in his maximum and she could put in her maximum. So that's a couple of interesting points there. Now, what we're going to do here in a couple minutes, we're going to head off to a break, but we're going to get into the most common one, which is your 401k. We're going to talk about how it works. What are the limits? What are some of the restrictions on this one? Because most folks out there listening are probably sitting in the 401k range. And we're also going to talk about IRAs, which is mainly geared towards individual folks who they may have a small business and they may not be able to participate in 401k or the 403b. So we'll go ahead and catch a break in just a second here. And so, but don't forget, if you'd like to talk about what your retirement plan is looking like, 772-340-1590. And I'd also like to know, what do you think about these limits? Should they be gotten rid of? I think so.
And just a point, you don't have to give any personal information. I mean,
that's right.
People are shy about talking about
you
their
don't
finances.
have to call in and talk about all of your stuff online here. But yeah, reach out to us. We're going to go to a quick commercial break and we'll be right back. Dreams. What do your dreams look like? And how far are you willing to chase them before giving up? Or are you willing to stay the course to achieve them Do you dare believe? Are you willing to work for them? Strive hard to never give up until they are realized. Are your dreams worth chasing? Well, if they are, welcome to Sun Palm Financial, a place where dreams become a reality. Whether your dream is to grow and to thrive towards the good life, or to simply experience freedom through financial security, come share your dreams with us. Sun Palm Financial. Invest, grow, protect. sunpalmfinancial.com.
Old money. Why is old money respected more than new? It's not because new money spends their fortunes outrageously and the old money gets jealous. Old money is respected because it has grown over time and is maintained over many, many generations. You see, most new money will be blown eventually or wasted by the second generation, and the descendants of new money just get poorer and poorer after that. But at Sun Palm Financial, we'll help you to create generational wealth that will grow with each new chapter. So if you've been fortunate enough to come into some new money, or right now to schedule your free consultation so that you can join the old club. Sun Palm Financial. Invest, grow, protect. sunpalmfinancial.com.
And welcome back to Sun Palm Financial Broadcast with D. Cummings. And you're certainly welcome to call in. Tell us what you're doing to plan for your retirement. 772-340-1590. Doesn't have to be detailed, just in general.
If you or your business
What
is
you're
behind-
what you're counting on.
Absolutely. All right, so as we're talking about 401ks, 403bs, we're kind of shifting into the 401k part of things. And the idea here is you definitely want to put something into retirement. You don't want to wait. I know it's tough times and folks are trying to balance their bills even right now. But at the same time, if you're not investing in your future, then who is? Naturally, Social Security is taken out, but it's just not going to be enough. I think we understand this concept. But we definitely want to get set up in something here. So let's talk about it. Yeah.
And we do have a caller. James from Port St. Lucie has a question.
Great. Hey, James, you're on the air, sir. Thanks for calling.
Hey, James, you're on the air, sir. Thanks for calling.
Okay, James, we need you to turn your
I'm
radio
retire
down.
pretty soon. I'm wondering about this. I keep hearing about a 4% rule. Could you elaborate on that 4% rule?
I'm sorry, James, can you repeat that? You came in a little bit hot on that mic there.
And excuse me, can you turn your radio off? Turn it off or down?
Hey,
There we
James.
go. We're getting an echo there.
Yeah.
Hey, James,
Okay.
I'm with you now. What was your question?
Okay. Yeah. Been reading a lot about the 4% rule as far as withdrawals from a 401k.
Right.
I was wondering if you could speak upon that.
Sure. What is your age, James?
I'm 62.
Okay, 62. All right. So it's very important to understand when you're going into take money out of these accounts. James mentioned the 4% rule. There's other restrictions as well. If you're going to take money out, you're going to be hit with certain penalties or fees if you do it before 59. So that's called an early withdrawal penalty. So when we get to the end of the show, James, we're going to be talking about an investment vehicle where you can actually be your own bank and access those funds without having those restrictions. So you definitely want to try, the goal of these, and the reason why they put those restrictions in the rules in place, they want to make sure that you're not going to take it out, that you're going to truly be putting it towards retirement. And so they do have these penalties, fees, and whatnot. But once you hit that 59 and a half age, which you have, of course, now you don't have the early withdrawal penalty. So you're in a good position now if you want to be able to access it. There are some other rules that are out there with the IRS, how they would consider it income, for instance. When we get towards the end of the show, we're going to be talking about an index universal life, also referred to as an IUL. There's a trick that we have with that one. So as you're making your contributions into that, similar to a 401k, you can actually borrow against it. You don't have to pay it back. So it's not a taxable event in that case. So if it's a withdrawal, then it is a taxable event. So a couple little tricks of the trade, and keep listening as we go along. And we're actually going to be touching on some of those variables, but you're past to 59 and a half. So a lot less things to consider there for taking the withdrawal out of your retirement. So thanks for calling in, James. All right, so we're talking about the 401ks, and there's a couple of different types. So let's talk about them for just a minute. So what is a 401k? Well, similar to the 403b, investors have many options when it comes to saving for retirement. One of the most common way, of course, to put the money in a 401k. Now, participation is voluntary, meaning you don't have to do this. You don't have to put any money away, but we highly suggest you do. And those who take part agree to automatic payroll deductions typically, and those are transferred into a special retirement account. And some employers will even match employee contributions up to a certain amount. This is really big. It's free money, people. If you put your money into the 401k and your employer is going to match, let's say up to 3%, 5%, 10%, that's a wonderful thing. Take advantage of it. If they're going to match it, that's free money going into your account. Now, it looks like we have another caller coming in.
That was a station call, and they'll call back.
Okay, sounds good. All right, so so some employers, they do match this. So there are several varieties of the 401k that exist, and one of my favorites, which most people have never even heard of, believe it or not, is called a Roth 401k. So what is a Roth 401k? So this option became available back in 2006. And while the traditional 401k has been around since 1978, I think it was, both were authorized by Congress as a tax advantage retirement plan that encourages people to save for their retirement. Now, when you hear the phrase Roth, and you'll hear it later in the IRA part, basically what we're talking about is you're being taxed on the money on the front end, so that later on when you hit your retirement age, guess what? There are no taxes. So I like to tell folks this way: what were the taxes like on your house 10 years ago, 20 years ago, right? That's a good, just kind of benchmark, right? Did the taxes go up or did they go down? Clearly they went up. So the benefit of that Roth 401k is you are making the money, contributing the money on the front end. It's taxed there. So if you're in a lower income bracket, it's not going to hit you as hard as if you're in a higher income bracket. It's taxed on the front end. And so then later on, when you hit retirement, everything that's in that account that you start pulling from is not taxed. It's a beautiful thing. So something to think about there. Now, traditional 401k reduces the employee's gross income for the year, giving them an instant tax break. In addition to a retirement savings vehicle, the employee will owe regular income taxes on every withdrawal made during retirement. That's on your traditional. Your Roth, of course, requires that the income be taxed immediately. And so the employee's real net income is reduced by the amount earmarked for savings, but no further taxes will be owed, as we mentioned, and withdrawals as well of either of the contributions of the profits earned over the years. So some really good benefits there are on the Roth 401k versus the traditional. It really may have the greatest benefits for the employees that are in a lower income tax bracket who expect to later on move into a higher income tax bracket after they retire, because technically they're taxed at the lower tax rate, right? And of course, like I mentioned, distributions are tax-free in retirement, making them a really great advantage. So not a lot of people know about the Roth 401ks, and it's a good idea to ask your employer if they offer them. And keep in mind, they still have the contributions and matching in some companies for these as well. The downside is there's a little bit more immediate financial pain, if you want to call it that. So if you're having these deducted from your paycheck to go into your retirement account and it's being taxed now, you're getting a little bit less. That's the downside, but the end game is free money at the end of the retirement time. So something to think about. Now let's talk about the numbers on this one. So participants, they can contribute annually to their 401k. It went from 22,500 in 2023, got a nice little bump up to 23,000. The contribution limit for employees who participate in the 401k, 401(b), and most 457 plans. I'm not going to hit on the 457 today, but just throwing it in there. And the government's federal thrift savings plan, that also, all that went up to 23,000 in 2024. So kind of nice to have that limit bumped up. It's only $500, but in the long run, 20 years, it would make a big difference, right? The catch-up contribution. So if you're 50 years old or above, you can do something called a catch-up contribution. That means that you can put a little extra in the account, and that way you can kind of catch up for some of the years that you may not have been able to put as much in there. The catch-up contribution limit for employees 50 and older who participate in the simple plans, that remains at $3,500 for 2024. And then there's a max contribution at 50 years or older to $30,500. Now, employers can also contribute to their employees' plans so long as the total contribution does not exceed the employee's annual salary. So for 2024, those limits are $69,000, and then of course for the other category, it's higher than that, $76,500 respectively. So, got a question for you before we go to a break. I want you to think on this one. And this is the question I've always asked myself. Why would the government cap the amount of money that you can contribute to your own future? Why would they put a cap on the amount that you can put away for your own savings? Why are you limited? It's a really good question. I've always wondered that. So I'd like to know what you think. 772-340-1590. That's 772-340-1590. Why is the government stopping you? Why are they limiting you? Why are they capping you? I'd like to know what you have to think. Give us a call in, and we're going to go to our commercial break. When we come back, we'll pick up on the end of this 401k part. We'll shift into IRAs, which is individual retirement accounts.
Dreams. What do your dreams look like? And how far are you willing to chase them before giving up? Or are you willing to stay the course to achieve them? Do you dare believe? Are you willing to work for them, strive hard, to never give up until they are realized? Are your dreams worth chasing? Well, if they are, welcome to Sun Palm Financial, a place where dreams become a reality. Whether your dream is to grow and to thrive towards the good life, or to simply experience freedom through financial security, come share your dreams with us. Sun Palm Financial. Invest, grow, protect. sunpalmfinancial.com.
Old money. Why is old money respected more than new? It's not because new money spends their fortunes outrageously and the old money gets jealous. Old money is respected because it has grown over time and is maintained over many, many generations. You see, most new money will be blown eventually or wasted by the second generation. And the descendants of new money just get poorer and poorer after that. But at Sun Palm Financial, we'll help you to create generational wealth that will grow with each new chapter. So if you've been fortunate enough to come into some new money, call right now to schedule your free consultation so that you can join the old club. Sunpalm Financial. Invest, grow, protect. sunpalmfinancial.com.
All right, welcome back to the Sun Palm Financial broadcast where we talk all things money. And today we're talking about retirement and retirement planning. We had a great question called in earlier by James. He had talked about the 4% rule. Basically what he's referring to there, the 4% rule, is kind of a popular withdrawal strategy. Basically retirees can safely withdraw equal to up to 4% of their savings during the year that they retire, and then adjust for inflation every 30 years for the subsequent 30 years. It's kind of a nice rule of thumb. It kind of reduces some ideas like risk tolerance, tax factors, some other definitely great strategies that can be implemented on that. It depends on, can you do it on 4%, right? But 4% rule, definitely a lot of folks are thinking about that one now because, of course, the cost of living has just gone up so high. So, is it even feasible anymore? It's a great strategy if you saved a lot. If you save too little, it's going to hinder you probably more than helping you. But that's just a few thoughts on that. Thanks to James for the question earlier. Now, talking about 401ks, 403bs, and some of these other retirement accounts, the Roth 401k, let's talk about the rollover, the famous rollover. What is that? People are saying. Well, when you leave an employer and they've had a 401k set up for you, and maybe they matched some of your contributions, and you leave this employer, well, then what? So this is a very important rule that you should know. If you leave an employer and you go to work for someone else who also has a 401k plan, you can do something called a rollover. This rollover must be done within 60 days after you leave your employer. So very important for those of you listening. If you're leaving an employer, you're going to a new one, 60 days to roll it over. Otherwise, you're going to get hit with some penalties and these kinds of things. Now, this is a bit of a concern for a lot of people because what if they were involuntarily cut? They may not get another job within 60 days. When we get down to the end of the broadcast and talk about IULs, we're going to highlight that. Also, you can roll it into an IRA, which is an individual retirement account. And that is the one we're going to be talking about next here. So you may also find that IRA often has lower fees, these kinds of things. So let's talk about what that is. All right, individual retirement accounts, IRAs. Now, if you don't have an option to invest in an employer-sponsored plan, you may want to consider one of these. This might be for small business owners. This might be some people just want to do it anyway, even if they have a 401k. And the reason why is they don't want to have to worry about, hey, when I leave my job and so forth, do I have to roll this over? What am I going to do with it? So some people just go straight ahead right to the IRA. So the account can be set up with anyone through a financial institution or an investment firm. So anyone who has earned income is entitled to one of these. So you can invest in a variety of investments under the IRA, including stocks, bonds, exchange funds, ETFs, mutual funds, even real estate investment trusts. So just like the 401k, there are different types of options for you. So similarly, we have the traditional IRA, and that one is you're taxed on the backside, and then the Roth IRA, where you're taxed on the front end. And then your contributions later on, they're tax-free as you're in retirement years. Now, something to think about here. There are limits on these as well, and they're much lower than the 401k. So for 2024, you can only contribute $7,000. Yep. And that's if you're under 50. Yeah. And
We're only 7.
that's
a
it.
surprise.
It is. And now if you're over 50, you can make an additional $1,000 catch up. So that's what makes these kind of like a question mark type of thing. We were talking about earlier, why does the government limit you for the ability to contribute to your own future and savings? It's perplexing. And Carol and I here, the engineer, we were talking about this earlier. Is it taxes? Is it that they don't want too many millionaires? Why do you think, Carol?
Well, or giving away tax incentives. I mean, there's a certain
Something.
tax break.
Yeah.
Or they want people to diversify their investments.
Maybe so.
I don't know.
I know.
Just
So
seems small.
if you've got an idea on this one, I'd like to hear from you. 772-340-1590, 772-340-1590. I'd like to hear your theories. Nothing too conspiracy minded for this show. Bring it. So here, when it comes to the Roth IRAs, finishing up on that, you can take the minimum contributions or not any at all, and you can leave the money in your account if you choose to do so. You'll be hit with an early withdrawal penalty of 10% if you take money out before age 59 and a half. And I think you can leave these in there for a good while. Someone mentioned to me that there's a rule change on that, so I don't want to put out how long you can leave them, because I think that's either about to be passed or under consideration. So I don't want to give you bad info on this. But there's one thing about all of these employer, government, and whatnot contribution plans that you should know about. There's one thing they mostly share in common, and you know what that is? Mostly, they are invested in the stock market. So stocks, bonds, mutual funds, some of these other things. And why do I mention this? Because if you have a stock market crash, and imagine you've been working your whole life and contributing to this thing, you've put money in, you've had the employer matching and whatnot, and guess what? You can lose money if the stock market crashes. So I had this conversation recently with a gentleman. We were talking online actually, and he has about $1 million in a 401k. $1 million in a 401k, and he was now shifting towards retirement. And as he's shifting towards retirement, he was leaving his money in the stock market, and he felt like it's just fine and it will do just great. Sun Palm Financial, one of the things we talk about is wherever you are in your life will kind of dictate what you should do with your money. So I advised him, I said, listen, I think now that you're shifting towards retirement, you should move that money, put it into what we refer to as a MIGA, which is a multi-year guaranteed annuity. This will be a fixed rate for a period of time. And sometimes you can get the long-term MIGAs, which are great. Right now, they're somewhere around 5.5% to 6.5%, depending on about 6. I think they just dropped a bit. So basically, you can take your money and put it in a fixed annuity, and you know how much it's going to be. And this way, if the market tanks, you're safe. You say, why do you mention this? Well, because if you've worked your whole life, 20 years, and all of a sudden you have a stock market crash, which we've had, by the way, 3 major ones in the past 20 years. So we had the dot-com bubble, we had the 2008 MBS mortgage-backed securities crash, and then most recently COVID. You could lose a bunch of your money.
And each time we've heard about people who are going to retire and can't retire.
Can't.
You know, they're continuing to work just because.
Absolutely. Yeah. So right as you think about it, right about the time you're about to retire, and now all of a sudden we have a crash and you can't. So his answer to me on this, which is halfway true, I confess, he said, well, hey, I'll just simply ride it out because the market will eventually correct itself. This is true. Historically, even when there's crashes, the market does eventually bounce back. It corrects itself. But here's the question. How long? It could take 5 years. It could take maybe more. And so if you've had, what are you going to do for income for that time frame, right? And do you really want to risk the loss of principal when you can't go back and work another 20 years and try to regain it? So these are some really serious questions that I had for him. So let's talk about what to do with your 401k if you're getting close to retirement. So it's not a good option, the correction to the market, if you have a crash, right? So I can either put it in a MIGA, multi-year guaranteed annuity, where you've got a fixed, it's kind of like a CD in that respect, but it's longer term fixed rate product. If you're like, I still like those higher dollar returns, the higher percentage returns. So we have something called a fixed indexed annuity that we could put you in. And basically that is where I'll take your money, I'll put it in an annuity, which is an insurance product. I'll index it to, could be the S&P 500. I could also index it to some other up to global indexes that are out there. So basically, we're not investing your money in the stock market. We're basically indexing it. We're watching the performance of this over here, and that performance we're going to basically mimic, copy, lack of better terms, we're going to credit the account based on the participation rate. So people are saying, what on earth are you talking about with this participation rate? So basically, that's referred to as a par rate in the industry. So the gains from the index are credited to the policy based on a percentage rate, participation rate. And the rate is set by the insurance company and can be anywhere between 25% to more than 100%. So for example, if the gain is 6%, the participation rate is 50%, and the current cash value is about $10,000, $300, for instance, would be added. So that's the 6% times 50% times 10% equals $300. Now, to most people who are like, what on earth are you talking about? It's kind of confusing, and it can be. So basically what we're saying is, you get, this is the simplified version, you get all of the benefits of the returns from the stock market, but you don't lose principal if it crashes. It's kind of a win-win situation. And any gains that you've made throughout that time, you don't lose those gains. Why? Because these annuities, in particular the fixed index annuities, have a floor, meaning it will never drop below X. Now, some of the ones that have the best performance, they might have a floor of 0, right? Meaning you won't lose principal or any gains, but you're not going to gain anything if the market has a problem. So, there are others that have a floor of maybe 2%, 3%. So in other words, if the market's having a bad day, having a bad year, you'll at least get paid that amount. So for those who are a little more risk adverse and they want higher returns, traditionally over a period of 5 to 10 years, we're looking at these returns, good returns, but they don't want to risk principal, that's the way to do it. And we're seeing a lot of popularity with these days. And because we have these really great indexes available to us, we have, for instance, an AI global index. So this is where the computer runs the numbers globally and can look at where the best place is for the money to go in the stock market and whatnot. So we're seeing a lot of we can index to that one. We can index to an energy index. We can index to the Standard & Poor's 500. For those of you who don't know what I'm talking about, the Standard & Poor's 500, S&P 500, it basically looks at the performance of the top 500 companies in the United States. So the only downside there versus the stock market is you don't get dividends from the stocks if you're invested in certain companies that give dividends. Not seeing a whole lot of returns and dividends kicking in these days for some of these, but of course the benefits outweigh it, in my opinion, because you don't have to worry about a market crash and the effect that it will have on your income. Because again, we're talking about your retirement at 65 or whatever. Do you really want to worry about having your money just disappear or go way down? Probably not. Probably not.
Not something you want to worry about now. Definitely.
Absolutely. So last but not least, we've got about 10 minutes left in the show. We're going to be talking about something that's one of my favorites here. We've been kind of shifting towards the fixed index annuities. Now we're kind of shifting towards index universal life. So what is indexed universal life, IUL? Okay, IULs, as we're talking about them, essentially it's an insurance policy. So you buy this IUL and you're automatically covered with a death benefit. And then like a 401k, you make contributions into it every single month. And it is also indexed to the stock market, NASDAQ 100, S&P 500, and you're getting those same earnings that you would, similar to a 401k. And we actually have some IULs. Sun Palm Financial is a preferred company with a lot of these big carriers. We actually have some that the income that you make from these is uncapped. Most of them are capped, but we have some where the income you make, the returns that you get are uncapped. So if it's a blowout year and things are really performing, you're going to get all of that. Now, some do have a limit, but the ones that do have a limit are still pretty darn good. We're seeing huge returns on some of these. And not only that, as it's moving along through your working life, as you're making these contributions, many of them have a guaranteed minimum interest rate. So if things shift and kind of go south, you're still going to be getting that guaranteed interest rate. And here's the best part. You can borrow against the cash value that you've accumulated in the policy. And you don't even have to pay back the loans because they would be deducted from your death benefit. So this is where in the industry, we call this being your own bank. So kind of nice. If let's kind of do a recap on this, right? So if you have your money in a 401k, there's no death benefit. Huge expense to take the money out, taxes and fees, somewhere between 12 to 15%. And then it also limits what you can put in. Limit to the contributions per year, even with a catch-up. And there's a danger to principal and loss gains, and taxed and probated upon your death. That's what happens to your money if it's in a 401k. It can be challenged in court against your beneficiaries. So let's just say you die and your money's sitting in the 401k, it would go to probate. If you have a will and you say, I want my money to go to my kids, your cousin's brother's sister who thinks that she should have rights to your money might challenge it in court, and then your beneficiaries would be dragged through court, lose a lot of money with attorneys just to have access to the funds. Employer matching, we talked about this earlier, is usually a very small percentage and it's capped. And then it has to be rolled over when changing employers. Now, that's the 401k versus the Index Universal Life. Index Universal Life, instant death benefit once the policy is underwritten, low cost to borrow against it, so you can actually borrow against what you've got in there. Usually somewhere the current rates are between 5 to 7% right now, not bad. The death benefit is the collateral. Now you can make monthly contributions and large annual contributions, and it has a floor so that you don't lose your principal, which is a big one. That's the one we talked about the most, or the gains that you've made in the investment. And you have the full benefit of gains in the market without the risk due to being indexed instead of invested in shares. It's not taxed upon your death because it's a life insurance policy, and it can't be challenged. So basically it goes directly to your beneficiaries. So the moment you die, it's a life insurance policy. You've already dictated who it's going to go to. It doesn't get taxed because it's life insurance. It doesn't go through probate, and it can't really be challenged because you have a named beneficiary. These are some of the huge advantages of IULs. And here's another cool part. A lot of people don't know this as well. Many of these IULs have what's called a bonus. So some of them at year, let's just say 15 or 16 of the investment, when you've really put in for a good period of time, they might have a bonus that kicks in that throws some money towards the account and bumps you up even more. And also, let's just be honest, we've got some pretty solid returns over there. So solid returns that often match or beat the S&P, very high cap or no cap on the profits in some cases, some of the products that we have access to. So any gains from the index and the participation rate. And the guaranteed participation rates are built into some of these IUL products. Yeah, so pretty good. All right, so we've got about a little bit of time left. Love to hear from you if you want to check in with us. Basically what we're talking about here is the best retirement strategies. Now, I also should mention IULs may require a medical questionnaire or screening depending on the amount because they are a life insurance product. So that's one part of this that you have to keep in mind. And some IULs, they're not all built the same. So some of them have they have a cap on their earnings, and some have a higher premium, payment that you make per month, and some have fees that could be expensive. So at Sun Palm Financial, we're partnered with the top companies who offer, some of them, no cap, low fees on the IULs, and you get tax-free income when borrowing versus withdrawing. So that'll be the last part of this. When you have an IUL and you've accumulated all this money throughout the years investing in it, it's indexed to stock market, not invested in it, but indexed to it. So you're getting those returns and that performance as it builds up. And if you, God forbid, something happens to you along the way, you've got life insurance automatically kicks in. Once you get to the end of this thing, you turn the switch at age 65 and you start pulling income from it, right? So what a great plan.
It is. We've covered a lot of territory today.
Sure have.
And for people who would like to call your office and talk about the specifics of their situation,
Yep.
The number is 561-783-3334. Sun Palm Financial and Dave Cummings.
Thanks for tuning in today. If you want to set up an appointment or talk to us about some of these things, you can reach us at sunpalmfinancial.com.
Thank you. We'll be back again next week.